The difference between a hedge fund and an investment bank. Let's learn more. Hello everybody, welcome to my YouTube channel. I'm your learning partner Sushila Hariharan, and if you're interested in a career in investment banking, hedge funds and global markets, do subscribe to my YouTube channel where we provide content-centric, research-focused videos on this topic. The entire financial ecosystem from a market's perspective can be classified into two categories, both of them being the same sides, two sides of the same coin. The two sides being the buy side and the sell side, the coin of course being financial markets system. So let's understand the roles and responsibilities of an investment bank and then the roles and responsibilities of a hedge fund in this market system. What does an investment bank do? An investment bank covers the entire spectrum of activities that helps an entrepreneur gain capital from different investors, that helps retail investors invest their capital into different asset classes like equities, bonds, money market securities, commodities, foreign exchange, etc. It also provides a very high level of research and innovation in in services like mergers and acquisitions, spin-offs, demergers. It also helps companies raise IPOs, that is raising capital from the general public for the very first time. So an investment bank has got two very strong divisions. The first division is the treasury division, and the second one, which is also a revenue center, is called as a corporate finance division. The Treasury division comprises of dealers who are dealing aggressively in global markets, including equities, bonds, money markets, foreign exchange, and they are trading in and trading out, quickly out of positions, exiting positions, entering into new positions, buying, selling continuously so that they make what is called as a treasury profit for the investment bank. The Treasury division is a revenue center and it comprises all the front office activities that involve trading in different asset classes to make a quick turnaround profit. Many of the trades could be speculative in nature, they could be highly leveraged trades. That means the investment bank is borrowing capital and then trading in the markets. So all this comes under the Treasury division of the investment bank. The second important division of the investment bank is what is called as corporate finance division. The corporate finance division helps a company or a client to raise equity capital from the markets. This is like an IPO from the very first time when it's raising capital from the general public. It could help companies raise debt from the markets, especially if it's a loan syndication. It could help companies also manage their treasury functions like foreign exchange exposures and so on and so forth. If a large company like ITC was looking to demerge its subsidiary ITC Hotels from itself, then it would employ the services of an investment bank to find out what should be the value of the demerger. So the investment bank provides a wide spectrum of activities that are highly customized, highly structured to meet the requirements of a large institutional investor or of large corporate houses. Investment banks rarely trade in small value transactions. They are looking at either boutique banks or bulge bracket investment banks, and both of them have as their net customers either high net worth individuals, other institutional investors, and of course the governments itself. So the investment bank services and the product repertoire is not available for individuals. It's largely available only for other institutional clients. This kind of wholesale banking, which is very specialized, very customized, very structured, enables the entire spectrum of capital raising, starting from getting venture capital right up to private equity, right up to IPO. All the services are provided by the investment bank. These fundraising capabilities are very strong, and some of the largest investment banks in the world include Morgan Stanley, JP Morgan, Citibank, etc., who provide these investment banking services on a large scale across different countries like the United States, London markets, India markets, and further east we go towards the Singapore markets and the Tokyo markets as well. So these are the kind of activities that the investment bank does. And because the investment bank is always client facing, they're always interacting with other clients, it's called as their sell side of the financial markets. The sell side of the financial markets refers to all the activities and services, the knowledge, the domain, the brain work, the research, the equity research, the bond research, the sectoral research reports. All of these are sold by the investment banks to other funds or to other institutional investors, so that they get the business of doing the transaction with the investment bank, and hence investment banks are called as the sell side of the business. On the other side of the coin, the same coin, is the buy side of the business, and that's called as the hedge funds. What are funds? Funds, when we use the term funds, we're typically calling into categorization pool of capital. A pool of capital that is pooled together from different investors but invested collectively by the fund manager is known as a pool of funds. This kind of a pooling concept is very unique in finance because the capital itself is agnostic to the investor, but it is very particular about where it is being invested. So hedge funds refers to the capital being pooled in from different accredited investors, that is investors who are high net worth individuals as well as who have high income levels, and this capital is then invested in different asset classes including equities, bonds, structured products, foreign exchange, commodities in different currencies like USD, EUR in different countries. So the hedge funds are a pool of capital. And because they're continuously searching where they should invest, what is the kind of money that they're going to be looking at investing, what is the kind of profit they have to generate, hedge funds must necessarily collect this pool from different investors. They must use very high-end quantitative techniques, strategies, asset allocation methodologies, portfolio management techniques, so that they are able to give a better than expected return, a higher than benchmark return. Therefore, hedge funds, mutual funds, insurance companies are all called as the buy side of the financial services spectrum. These include some of the largest names, including BlackRock, Citadel, etc. The industry collectively invests more than $55 trillion in global markets, thus making them a very formidable capital contributor to the market ecosystem. So the investment banks are called as the sell side of the financial markets, and the fund industry is called as the buy side of the investment banking, or the buy side of the financial markets. The investment banks sell their services to hedge funds. Hedge funds buy these services so that they can deploy their capital in a far more effective manner. Thank you so much.